Amira, would you like to start?
Sure.
Just a second. Just a second. I will share the PPT. Yes, please.
Yeah. So, good evening, everyone. Welcome to yet another interesting webinar, but this time it's on commercial substance in the UAE corporate tax law. Before we begin, I'd like to give a quick introduction about TransPrice Tax. TransPrice Tax is a cross-border tax solution firm with a strong presence in India and the UAE, along with global footprint through Quantera Global, a prominent network specializing in transfer pricing. Now let's do a quick round of introduction of our speakers for today. We have Ashna Mulgaonkar. She is the managing partner at TransPrice GBT Tax. She has nearly 2 decades of professional experience in finance and administration within the UAE, and she's a highly regarded chartered accountant and tax consultant. Her expertise extends to various areas with taxation and accounting. And we have with us Akshay Kenkre, who's the founder of TransPrice Tax Group. He is a highly skilled cross-border tax advisor and a chartered accountant by profession, specializing in transfer pricing and international taxation. Akshay is a passionate author, having published 4 books on taxation. So before we get started, I request you all to keep your microphones on mute, and I encourage you to ask us more questions. And you can put your questions in the Q&A box over there on the top of your screen. And yes, now without any further delay, I would like to take it. Now you can take it over, Akshay.
So, thank you, Amira, for a very kind introduction. Good afternoon and good evening to all. Uh, I think with the response that we have got for this webinar, it shows the relevance that this topic has at a global level as well as in the UAE. So, great. Yeah. Okay. So guys, I've passionately studied tax over the year, and I think taxes in the entire finance and economics is one of the most innovative subjects that I've ever studied. Uh, we have built humanless models across the world much before even AI was in existence, right? I'm talking even 40, 50 years back. Uh, Examples are right here on your screen, where these are just examples, okay? These are not real life case where companies could have been formed in the Bahamas without a single employee. There was a possibility of doing trading without a single warehouse, just a simple invoicing from one place to another. We still do it. We call it the high seas, but again, with substance is something that is important. Yeah. Certain managements who are controlling the overall global managements and activities. That was something that was possible until today. Yeah. So there was a possibility of creating global structures without business realities or without taking into consideration the business realities and the boundaries that the countries have. Now, this is all a thing of past. Uh, that's very difficult to build substances uh, without its core economic activities now. Today, one has to take care of the actual business conduct and the economic realities in and around, right? So this is called as a test of substance. Uh, Taxes generally is always called as law and practice. Now, it's very important to understand it's also practice, which means it is practical. Every law that you study has to be read with the actual facts of the case. So whenever the facts of the case would differ, the legal interpretations of such a law will keep on changing depending upon the facts. Same is the case even with taxes. Very crucial to understand before getting into the topic of commercial substance that why we are discussing this. overall at a global level, there are multiple strategies that a company could follow from a taxation perspective, right? Broadly, these categories could be considered as four categories. The fourth one was added recently by the OECD, but popularly there are three T's of any global structures or the way of doing business. Uh, on the extreme left, this is exactly the way how you should not do business, which is the tax evasion. This completely means that you are taking all illegal means to avoid and save taxes. Your tax is a cost of you doing business, right? If you don't want to get into incurring cost, the best way of keeping the tax cost out is by not doing a business, right? A tax evasion is a clear indicator that you are not driving a legal means or even not having any moral or ethics uh, for a particular structure to be built in, which means you are booking most of the expenses as bogus expenses. You are having employees only for namesakes, and whenever you are paying salaries, it's going through cash and somewhere to somebody else and ultimately lands in your table. There is a lot of undisclosed income. So this creates something called as a black economy or a black market, right? So tax evasion is harmful for an economy, right? And what's the exact opposite of it? There are avenues in taxes. And the government wants you to undertake these avenues so that you can plan your tax cost well. So this is incentive, and that's called as tax planning. So these are fiscal measures which the government themselves say that do certain things in a particular way, and we will give you certain deductions around taxes. Now, your regime of free zones, right? That's one of the best example at a global level of tax plannings. Your entire IP regimes, right, or innovation boxes. These could be good examples of tax planning initiatives which doesn't harm an economy, but on the other side, incentivizes the business to invest more in that economy and also undertake a lot of hiring and economic activities in a particular jurisdiction. Now, to be very frank, tax evasion as well as tax planning are not the big headaches of any economy. I'm repeating it, they are not a big headaches of any economy. Every economy might need certain amount of unstructured parallel economy to run, and that's what the tax evasion contributes it for, right? What is really harmful is a very structured tax avoidance strategies which has the potential to rip off the entire base of a company on which profits could be made or the profits of the company on which taxes would have been paid. And that's why there is a terminology called as base erosion and profit shifting, because tax avoidance will focus on base erosion and profit shifting. And although these are legal means of you driving a business and ultimately taking tax decisions, what is absent in a tax avoidance strategy is the commercial substance. So, what differentiates tax planning and tax avoidance is commercial substance. And this is the reason why we are going to discuss this topic today. Because tomorrow, when you are in front of a tax authority, only the commercial substance that you are able to prove is going to save you from being categorized either as a tax avoidance or a tax planner, right? So, uh, I've just put certain logos on the right hand side. These are global multinationals which in 2013 and 2014 have been accused of tax avoidances at a global level, right? And they have been running certain tax avoidance scheme. Uh, but I would say most of the countries didn't have things like anti-avoidances or maybe a general anti-avoidance, which never prevented these companies to take advantages of certain tax structures. So 2013 and 14, this became the basis for the BEPS program to come in, and the global discussion around tax anti-avoidance started. Now, as we just discussed, specifically from a UAE perspective, now that you are getting your corporate taxes in, uh, how would not having substance would drain a particular economy? It could mean overall reduction in the government revenue because the government got in taxes with a certain objective of earning a higher piece of revenue. Uh, but if that is not going to be met, it will deplete the resources that country has. It will also lead to, of course, inequality and unfairness in the industry as such, and ultimately most of the residents in a particular country will lose trust on the government. So taxes is a very essential and sensitive area of practice as well as discussion between the governments and the residents. So this could be a deal breaker or a deal maker. Now let's come to the topic of what a commercial substance is, because I've been talking about this particular term, commercial substance, what it really could mean. It actually says that any business, so why you do business, any business that you do it with a perspective of earning profits, either a capital profits or a revenue profits, right? If you are going to do business from a perspective of only tax saving or getting a tax benefit, then the entire business lacks a commercial substance. It's essential for the business to build a commercial substance by showcasing that the business is built for undertaking economic activities. Let's just quickly understand through examples of what denotes substance in general, right? So if you are a company and you are providing certain services, then ideally you should have an office space, right? Along with office space, you should also have employees sitting in there. This is the typical trait of any service company which is providing services. So if you have these two, ideally you would have a good amount of substance. Now we'll add one more layer to it. So if you're a service company, then you should also have qualified employees who are qualified to provide such type of a service, right? So you need to get into that level of detailing. If you are a trader, then you should have warehouses in ideal scenario. You should have some place to store. If there is no place to store, ideally then you become an agent. So your characterization could be different, right? If you're an IT guy, if you're an IT company, then ideally you should be having your servers, your equipment, your websites. That becomes more of a substance creating activity for you. For manufacturing units, your assets, for your sales units, your marketing assets or trademarks, brand names could be one of the substance showcasing uh, uh, elements, right? Management of the company is also an essential element for showcasing substance wherever management decisions are taken. And we deal a lot with place of effective managements overall. So wherever the place of effective management is, ideally the commercial substance of the strategic business is located there, right? Your headquarter or the HO service, right? Ownership to certain level may or may not represent substance. What we really need to question is on the beneficial ownership and just not the ownership. So a shareholding or a shareholder being there in the country of where the company is not going to be enough proof to showcase substance. The beneficial ownership of the shareholder needs to be tested, and also the activities undertaken by the shareholder needs to be tested, right? And last but not the least, it is the active and passive test. I'll give you a quick example. So if you're a manufacturing company selling goods across, if you are set up in UAE and if your income is going to be interest income, then at a global level, you're a manufacturing concern. But from a UAE perspective, you are only a passive generator of interest income. So you may want to create your commercial substance only around getting in the interest income, or maybe deploy certain people in a way who can handle your finances, and you can showcase that your finance is getting handled in the UAE. So the picture here represents the actual substance where this person is actually based in the UAE. He's on the beach of the UAE, enjoying there, spending time, living there, and also working from the UAE. So this is very crucial for the actual people to be on the ground.
Hope it's
Now,
not AI generated. Hope it's
no,
not AI
this is
generated.
not AI generated. Of course, there are substance is something that people need to generate, and I'm sure substance is something that AI can never replace. So, thanks for coming in, Asna, at this point of time. ESR regulations have been a talk of town, I think, since the past 3, 4 years now. substance for the first time, I think, has been spoken at that point of time, and there was a lot of hue and cry discussions around it that there is no taxes, but now the ESR regulation is there. The AML regulation was around the corner. So, would you like to throw certain light on the substance and the importance that it carries with the ESR and your experience around it, Asha?
Yeah, Akshay, before touch base, ESR, I would like to I would like to bring up a point on tax evasion. So UAE didn't have taxes, as everybody knew. It was VAT where the tax journey started. VAT, then ESR, then corporate tax, POEM, P. These are all new terms that happened around in the last 4 5 years to UAE tax regime. But tax evasion, how people have been doing it around in UAE, and what steps government has taken to detect these people. For an example would be, suppose in a VAT industry, if a business in the UAE is importing goods that are to be taxed at standard rate, but this business states that these goods are for re-export, but however these goods are stocked here, they are consumed here. Ideally, you have to pay 5% VAT on these goods. But the goods and the documentation is structured in such a way that it is shown as it is for re-export. So to catch these kind of transactions, the government came up with something called as whistleblower program, which was called Rakib. And the government also incentivized people who would report these kind of tax evasions. So the government has already taken steps in various ways in which whistleblowers could be reported to them. So tax evasion has been a very serious is been handled very seriously by the government of UAE. So yes, as you rightly said, there's a thin line between what is tax evasion and tax avoidance. And tax evasion is also harmful to the country of UAE. Now, going back to the ESR, ESR, as the name itself states, it is an economic substance reporting. So it's not, now companies have to understand what is the difference between a form and what is the difference between a substance for any company to do business. You cannot if you cannot differentiate between the form and substance, is where the problem arises. Economic substance reporting is what I would say. It's like building the substance around the company, building there are certain tests for economic substance in the ESR law. First of all, you have to understand what is the staff strength you need for that type of a license in the UAE. What type of board meetings you can handle when it comes to the management of the company. What is the substance, in the sense, do you need a warehouse, do you need a proper office space or not, where will you be conducting the activity from? So there were three main tests that the economic substance report law covered. One is the license and the relevant activity from where you are doing. One would be where you are actually generating your core revenue. Is it from the UAE, it is from the free zone, it is from the mainland? And what are you I have do you have adequate people or premises and adequate expenditure in the UAE? So how would you actually justify what is the definition of the term adequate? Is been a question of debate here. So when it comes to India or any other jurisdiction, Akshay, how would you define a term as adequate? Like, there is a, suppose you can take a business of third port shipment. As you know, you don't need many people handling that business in the UAE. Third port shipment can be done with two people, but the turnover size can be very significant. So when it comes to adequate substance, what are your views on this term?
Yeah, adequate is a very subjective topic, and I think we'll cover that surely as we run through the presentation ahead. But very interesting point made, which I maybe a secondary question to you. Uh, if ESR is well met, am I very protected from a corporate tax point of view, or still I need to do a lot of study around substance and corporate tax?
Yeah, so what happened with ESR coming, right? In the ESR, the substance test had to be met within the state, within the UAE. So wherever the company is, if you have this substance, adequate substance, for example, within the UAE, then your ESR, you are ESR compliant. But for corporate tax, and if you want to take the benefit of the 0% corporate tax, they have very clearly carved out a provision saying that your substance has to be within the free zone, within that designated free zone. So if you are doing a distribution line of business, you have to have adequate substance within the designated free zone, and at least 95% of your core income generating activity has to be from that particular free zone. So now there is a distinct difference between ESR, what was the substance as per ESR, and what is the substance as per corporate tax law. So if you are meeting
Okay.
substance of ESR, you will have to rework and see if you are meeting it as per the city as well.
Okay. So just to decode, it means that in ESR, it's a separate law in itself that doesn't directly assume that you are meeting substance in city. There are various provisions which we are going to discuss. So these are two separate, mutually exclusive topics. And to take care, you will have separate ESR documentation and other corporate tax documentation, right?
Yes, they are more, they are, if you see interrelated, there are many common points interrelated, but yeah, the laws are completely different, and there are certain terms which are distinctly different for both the laws. So it's very important to understand both the laws, and then see how you can, design a framework for your own organization.
So ESR is not GAR, right?
Okay, when it comes to GAR, I think the first time when I saw this word GAR in the law, the first person that came to my mind was your book. You are the best person to, take up this topic. But before that, I would like to, give you a perspective of what happens with GAR in UAE. This is a typical case which we can think about. When it comes to substance, when they say your substance has to be in that qualifying free zone, there are businesses which are there in mainland for like 10, 20 years, nobody knows how many years ago. Now if they have to take up the provision of the benefit of this tax as a 0% rate, and they have to shift their entire business from the mainland to the desired free zone for the tax benefit, shifting the entire base of the business and going to the free zone, how would one justify this, and how does these provisions come under GAR? What are the precautionary measures the company actually need to take so that GAR doesn't get triggered here, or does GAR specifically get triggered here? Because uh, I think you are the best person, you can take over from here.
No, so I'm a student of this topic and I'm learning every new things every new day. So I think gar in Marathi means cold. Yeah, so it sends shivers and cold to businesses when they hear about gar, right? So of course a separate topic, but I would like to congratulate the UAE government that when they got the tax law overall incorporated and deployed in the UAE, GAR was already existing as one of the articles in the decree law. It was not the case with India as such. India had its tax law across, and tax was always looked through the eyes of legality. It took India a lot of time to understand that substance is something that needs to be incorporated, and it was only in 2012 that the first GAR committee was ever formed, with ultimate GAR getting implemented since 2017 in India. Now, if you remember certain cases like Vodafone case, which is widely spoken about, I think the results could have been very different if from a Supreme Court perspective itself, if GAR would have been in place when this case really happened. So, what does GAR really mean? It's a global concept, and it actually means General Anti-Avoidance Rules. So these are regulations or general anti-abuse rules, as the UAE law says. So it's a regulation that gives a lot of factual detailing to a tax law. And there are two main questions that it asks for every transaction that it is getting entered into. The first question is whether are you undertaking this transaction for a business purpose? Now, ideally, A business purpose means commercial reason or having an economic activity purpose. The second question it asks is if the one of the main purpose or the main purpose is going to be corporate tax advantage, then if the answer to these two is yes, then you are in trouble from a GAR perspective. But if answer to any of these two questions is going to be no, then the GAR is generally not applicable. Let's take into consideration your question around mainland to free zone while things were while the company was existing for last 20 years. I'm not here to give answers, okay? I can only apply mine from a GAR perspective with whatever little knowledge I have. Now, if there is going to be a commercial reason why the shift took place from mainland to free zone, right? And if you are able to detail it out in your board minutes, in all your factual documentation, giving reasons of business on the shift, right? Then you would meet the substance test. Second is the purpose should not be, or the main purpose should not be corporate tax advantage. Now, the fact is, if you are going to shift from mainland to free zone, and in free zone, if you are going to meet all the conditions, then you are going to get 0% instead of 9%. Then it's very difficult for you to prove that the move that you made did not have any purpose because it says main purpose or one of the main purpose. So there could be multiple main purposes and there could be various secondary purposes. In such a situation, it's difficult to prove that your secondary purpose is a corporate tax advantage. So your main purpose has to be extremely strong, right? Of course, there are brainstorming that needs to be undertaken here whenever you are taking decisions like these. Nothing right, nothing wrong. But if you falter in one of these two, then there could be a possibility that either authorities might just disregard this entire transaction. It might just disallow certain amount of expenditures. It can reallocate the expenditures or income somewhere else. They have the power to recharacterize. They have a power to disregard the arm's length price, right? So the powers on the GAR front are extremely powerful from a tax authority perspective, right? In countries like India, there is something called as GAR panel that is set up. So the tax authorities directly don't take it up. There is a high possibility that such panel would come up also in the UAE. But again, more than taxes, I think more than transfer pricing, substance and GAR discussion will be of higher prominence going forward. And good that such concept is already existing from day zero in the UAE law.
But in India, there is also this SEZ, right, Special Economic Zone, which is quite also Gift City, which is now also taking up trend here. But there is any provisions around GAR there as well? Because see, when a company like who's established for 10, 12 years and was always doing business in UAE without any issues. In fact, most of the companies who are based in the free zone always had a mainland line of business to for an easy line of distribution. Now to shift it back to the free zone and then explain to the governments here on the commercial pride and that tax benefits are secondary is always a topic of discussion in UAE. But do you see anything like this in India as well in consideration of special economic zone or gift city?
So, from an India perspective, Asna, if you look at these regulations, right, like GIFT City, there is a separate regulation around IFSC and IFSCA, which is the authority governing the GIFT City. Most of these SEZ are extremely well regulated, including from a tax perspective. So there are tax holidays for these SEZ. Some of them have now sunset clauses and some of them are going away. But whenever they had, India never contributed to tax avoidance internally through SEZs. These were tax planning measures and they were always well regulated. But GAR as such applies across. It doesn't only apply to, we don't have something called as mainland and free zone. Your SEZ also forms a part of mainland where the overall tax law applies. So that's the main difference. It's just the way how taxes or maybe laws are applicable to certain jurisdictions. Yeah, but these I think issues are more UAE centric. India is a different economy altogether through this. Moving ahead, when we speak of GAR, we have to speak of BEPS, and when we speak of substance, we have to speak about Action Plan 6. So earlier, I was always wondering on Action Plan 6 that that's the action plan which is really talking about substance and bringing in substance over form principle. But when I laid down all the action plans on the table, I was shocked to see that more than nine action plans have one thing in common, is that every action plan is really talking of substance, right? Your interest deduction is talking of substance from a quantitative perspective. Your harmful tax practices is talking of certain IP regimes. Again, they are questioning the substance. Preventing treaty tax abuse was talking about substance. Your PE status was again talking of substance. All your transfer pricing things, other than the documentation, was all about substance. So your entire BEPS project was a substance-oriented project where they had to bring in certain legalities to drive substance into the respective uh, treaties through an instrument called as MLI, or a multilateral instrument, right? And this is how important substance was in the website. So talking of UAE, and we have been discussing on BEPS Asana since a long time. Would you just want to give an overview of how a UAE law substance requirement could be different than the BEPS Action Plan 6 substance requirements, maybe in a very broader sense? I know these two are very, very detailed topics to discuss on theory, but where would these two apply?
Yeah, so as you know, UAE law is very local. Yeah, it is for the UAE jurisdiction itself. So they are more focused on how you will create the substance within the UAE. How would you build up your company? How would you have offices, employees, board meetings, poem issues? These are all what is focused per se from the UAE perspective. And how would you create substance? How would you carve out the economic benefit from this transactions? It's all, the law is entirely covered around the UAE regime. But on the other hand, you cannot read the UAE law only standalone when you're doing global business without taking BEPS Action Plan 6 into consideration, because BEPS Action Plan is more focused on the treaty benefits. And just reading UAE law as a standalone, you will not understand what benefits you have or what benefits you can't avail without taking BEPS Action Plan into consideration. So it's very important here to correlate both the laws when you are doing a global business here, is what I
I
see.
think the power of BEPS Action Plan 6 was more around treaties to prevent treaty shoppings and double non-taxation. While and it's so much focused on commercial substance because it's actually a bridge between two
Bridge
economies while
between.
doing business, right? So if both the economies have GAR at their end, and then they have an MLI and they have an Action Plan 6 sitting on top of that, I think the entire pipeline or the value chain of doing transaction is protected through an anti-avoidance measure, which does not entertain treaty shopping and which clearly denotes the culture that the tax authorities have. So you should read generally the UAE domestic law with Action Plan 6 and with the other countries' GAR regulations also, or any type of regulations with similar nature, and link it with each other to ultimately make a business decision, right? Because there could be possibilities that certain things are here and there, and everything needs to be considered as one piece of advice. So these things needs to be kept in mind. Talking of free zones, I mean, this has been one of the favorite topics, and you did mention about adequacy. I would love to bring in the concept of transfer pricing around it. But how have been the discussions in town on free zone? Are we getting all free zone benefits just like that, or do we need to really do something in terms of substance to get it?
Yeah, so ESR was mainly designed, as you can see, the first focus around ESR was on your core income generating activity. You have to understand what is the activity that you are doing in the UAE. It is not only about undertaking the activities, also about what are the adequate number of staff that is needed and how do you define the word adequate again. Then comes into question is, where are your assets based? Like, where are your assets in the UAE or the assets are outside of the UAE, like an IP in question, where are your IP based? Then came in the adequate amount of operating expenses that you're spending in the UAE. If you have a manufacturing unit, what is adequate amount of expenditure is what a company had to be focusing on now. Adequate does not you see, there are certain facilities in UAE here which are just taken warehouses and they say they're doing manufacturing units. So it is not what the law is looking at. The law is looking adequate in the sense, if you see ESR law, in fact, they have carved out what are the expectations of board meetings, what are the expectation of adequate number of employees. There are certain provisions which they have carved out. Like in board meeting, they have specified what is the expectation from a board meeting. Like one thing that they have mentioned is quorum of the directors should be physically present in UAE. Meetings should be signed and maintained, records should be maintained in the UAE. Directors attending the board meeting must have necessary skill and expertise of knowledge. This is also a very important point which most of the companies do not adhere to. So when you say physically present in UAE, in this world of technology where meetings are happening across online, how would one document such meetings? So this is where the challenges is this market
But
is facing.
surprisingly, you covered ESR a little bit while you're speaking on the free zones. But if you look at the cabinet decision 100, if I'm not wrong,
Mhm.
they have really not got any element of management or board in that particular meaning of substance in free zone, which means, are they keeping the management outside? Which means you can have the management in the free zone, while you could have the core income generating activities in so management in the mainland. So sorry, and you have the core income generating activities in the free zone. You could have employees in the free zone, but still the management and decision making in out. Is it very different than ESR when it comes to the guidance around free zone substance creation?
It is because see in ESR the confusion was ESR was substance in the state, and for city this is substance within the free zone. But again, as you said, 100 the cabinet decision 100 doesn't carve out specifically on the board of directors meeting. But ESR does state that the director should be physically present in the UAE. In the UAE, now UAE means it can be mainland or free zone also. But at
Yeah,
the
yeah.
same time, when the condition for a qualifying free zone is that you meet the substance in the free zone. Even if you are even if you're outsourcing it, you have to outsource it in the free zone. So if you're saying that, I mean, if you look at it that the board is sitting in the mainland and all the activities are being driven in the free zone, what type of substance and structure has been created in the free zone should also be understood, right? You cannot have just a license and operate fully from the mainland and say that you are meeting the economic substance test in the free zone.
No, very true, very true. What's especially caught my attention, which you also brought it to a discussion earlier, was this term in free zone cabinet decision as well as ESR, which is adequate. And I think that's the favorite from a UAE government's point of view, where they say adequate. Now, from my perspective, adequate is a very subjective word to have it in taxes. And when you match that with substance, right, it could create trouble. So let's take an example. When you say maintain adequate amount of operating expenditure, now what do you mean by adequate amount of operating expenditure? Does it mean I should have 500,000 of operating expenditure? Does it mean my percentage to revenue operating expenditure should be certain amount? No safe harbors, no regulations have been prescribed to describe the word adequate. What I genuinely feel is when the stake is high, maybe one can use transfer pricing principles to prove what is adequate, which means if, say, my employee to sales ratio of a similar business is 30%, and if I'm keeping my 30% of employee strength or maybe 30% of payroll in a free zone, then I become or maybe qualified for free zone with adequate number of full-time employees. So transfer pricing applies to free zone, but I feel transfer pricing principles are more important to describe this word adequate, which generally have not been really clearly stated. So everybody should just make a note of it, that wherever you have confusion around the term adequate, maybe let's apply the transfer pricing provision and see what the result of that adequate could be. So maybe one thought just to leave back with all of you. Yeah, and I think while we are on the topic of transfer pricing, a quick continuation is I have had many discussions on substance in India also and in UAE now with the GAR is there that I am meeting the arm's length criteria. In fact, I am more than arm's length. Does that mean that I am also meeting the commercial substance? The answer is no. You don't meet commercial substance just because you are at arm's length, because transfer pricing as a regulation is a SAR or a specific anti-abuse regulation or specific anti-avoidance regulation. Being on arm's length in transfer pricing is only a valuation exercise of your price and your profits. It does not give validation around the structure that you have or the transaction that you are driving is with your commercial substance. It does not even tell you the purpose, right? Let's take an example in terms of what I'm discussing. There is something called as thin capitalization rules that are come in UAE. This is your limitation of interest benefit clause, which is again a SAR. It's a quantitative SAR where only 30% of EBITDA would be allowed in terms of your interest expenditure, whatever interest expenditure you do, right? If you are meeting that test, then you are at arm's length in general case for thin capitalization. But nobody asks a question that whether the person who is utilizing that particular loan, whether he is the beneficial utilizer of that particular loan, why was the loan taken? What was the business purpose behind taking that particular loan instrument? Who is the beneficial interest gainer in this particular transaction? So all these questions needs to be answered in a substance document. Now, where this substance document could be, a transfer pricing documentation could be considered as a substance document and a great place to write all of this. But TP will not solve your commercial substance issue. Yeah. Let's take another example. Let's take an example of a full-fledged manufacturer now getting converted into a contract manufacturer. Now, in transfer pricing, one can analyze what is the type of transaction that should be entered into to gap the difference or the buying payments when the restructuring happened. But it never gives you a commercial rationale behind why the restructuring happened. Was there a tax benefit embedded from a long-term perspective while doing that particular restructuring? Similar other examples could be your management fee exchanges or a cost contribution arrangements. The question around why, who, when, these are not asked in transfer pricing. TP only asks the question on valuation. So I'm just giving you all these examples because transfer pricing will not mean that you are meeting commercial substance. These are two separate regulations, and you need to treat these two separate regulations differently. Yeah. And that has been overall experience also from a global perspective. Now, straight away, let's dive more on the practical side. Now that we have almost 20 minutes into, we are left with 20 minutes. Ashna, quick question to you on the case studies. Let's say a multinational company is setting up a regional headquarters in the UAE, and they are thinking from two perspectives. First of all, it's a strategic location. You can hire great people there, cross-country people there, but also I will get a lot of tax efficiency. Instead of India or US, I would like to put those high earning people in the UAE. So will this meet the test of GAR? Yes, no.
Yeah, so if you see UAE law perspective, it is very a holding company, encouraging holding companies to be in the UAE. But again, when you are shifting a base, you have to rationalize whether the commercial reason is there, economic reason is there or not. Unless all these reasons are rationalized, GAR will come into picture. So there cannot be one answer to this unless the facts of the case has been studied. Because when it is shifting an entire head office base, the main reason should be first the commercial reason, the economic, and secondary can be a tax benefit or what comes along with the shifting. But just you cannot ignore GARF when you are taking a decision of shifting, especially with taxes now global and global minimum tax also coming into consideration soon and getting implemented in UAE. When it is a shifting a base, yes, GAR will come into picture provided all the other conditions are met.
Right, right, right. So maybe looking at the second one in terms of manufacturing facilities, if you're
Yeah.
maybe I'll
So
quickly
maybe you
please
can
go ahead.
cover this investment. You can cover the investment in manufacturing facility. If you are going to shift an entire manufacturing facility or state of art in the UAE, definitely jobs, there will be jobs, there would be revenue benefits to the country as such. But what about GAR? Do you see substance and how would you treat substance and GAR in this case?
Now, substance is crucial, I think, and whenever you're setting a manufacturing facility, you will need employees, you will need factories, you will need equipments. With all of this, I think in general, for manufacturing facilities, substance is not going to be a challenge. The challenge there would be more of what type of manufacturing facility it is. Is it controlled by, say, a foreign company? Is it controlled internally? Is it an entrepreneur? Yeah, all those aspects will come into picture in terms of decision making, which are not per se in the free zone type of situation, but at a GAR level or a larger substance level could be a question, which means it's only a contract manufacturing, or maybe it's an entrepreneur and whether it is acting just like a contract manufacturer. So, but I would say in general, manufacturing facilities are somewhere, if they pass all the test of substance, ideally they will have substance in that particular country. Yeah. Similarly, with research and development, I've seen multiple structures being created where research and development is undertaken by one country while the IP is held by another country. Now, here essentially one thing needs to be understood, that the company or country which is holding the IP, whether it has the control over the IP and whether it has an active strength to finance the IP outcomes, right? Whether it has its own strength to finance the IP outcomes, and if it yes, then how that funding is going to be routed through. Is it a case that I'm an intermediary IP company and I'm just getting funds from somewhere and diverting it to, in this case, say Egypt, which is the third case, right? So if this is going to be a case, then substance could be a question. Otherwise, in India, at least we see a lot of IP models being developed where India acts as a service center and the IP results are transferred somewhere outside India.
So this is a very interesting case, Akshay. Maybe, if there is a company in US and if the company in US gets a contract of construction, say in UAE, but instead of directly assigning the contracts to UAE or directly forming a company in UAE, they form a company in UK, wherein the substance has been created, and from UK, then they assign the contract to UAE. So how do you see GAR or substance here? Because as you know, US and UAE does not have treaty. So if they bring in UK, how would you see and how would this be challenged by the tax authorities? Can this be
So,
challenged by the tax authority?
so maybe Asna, if the thought for getting UK was mainly to get any type of treaty benefits, which never existed, or maybe to genuinely avoid double taxation, because there was a double taxation happening because of the contract that US got from a UAE based customer, right? Uh, Substance needs to be checked, and whose substance would be checked in this case, because UAE there is a PE, right? So which is, first of all, the UK's or the US company's PE in the UAE is something that will need a substance check. And secondly, in this case, the UK company will have to have a substance check. So see, you are actually doing a UAE law evaluation, but when we are looking at structures, it's cross country. So in such a case, although from a PE perspective, there is something called as attribution of profits for the activities that the PE will undertake in UAE. But if you see, the contract is given by UAE to a US company. Ideally, a US company should have come to UAE and should have done business in the UAE. But right now, it is only allocating a part of attributed profits to UK, not even US, into UAE. So there is a big question mark around the commercial substance of UK first. Second, there would be a big question mark on the business decision of why this particular structure was built in. And third, why UAE should only get the profit that it should be attributed for. UAE should also get profits for, say, decision making. Just because the decision makers are sitting in the US, the profits around the strategic management will be attributed to US by the PE principle, right? So there is a bright chance that a commercial substance could be questioned in this particular case, and a US company would be said to be doing a direct business in the UAE, and a full profit attribution could be expected by the UAE tax authorities in general this case. So a UK company would be covered completely overlooked, or the wheel could be lifted for the UK company in this case. Does that help?
Yeah, because see, first of all, the contract is with US company. UAE is the final ultimate where where the project execution has to be done. Bringing in UK, and how would you justify why you brought UK? There is no UK here at all in the picture when the contract is US and UAE. This is going to be a trigger point. Yes, what you said is right, that justification has to be there around and all the clauses, but
Yeah, yeah. And similarly, I think Asna, we spoke about IP, and there are a lot of cases where, say, a US company would love to house their IP in a tax haven because of secrecy norms, and say countries like UAE will pay royalties to these tax havens. In such a case, the beneficial holder of that IP should be looked into, and not a tax haven who is just holding IP without any economic interest or a legal interest in it. It's just holding because of secrecy norms. It doesn't have any power to hold those tax IP. So if you are getting any treaty benefits because of it being held in a tax haven, then the tax haven will again need a lift of corporate wheel. So you don't have withholding taxes at this point of time, right? Or do you? Ideally, no. Is
no. But the one thing I want to say about IP here is in ESR, IP is already considered as a high risk activity. So those who are into IP, those who are paying royalty, already because of the ESR law, these companies have to report to the government. And there has been a detailed reporting. We have done a lot of reporting with companies who are holding IP. So when you do reporting on specifically an IP, there is a very detailed questionnaire which comes from the government, where the IP is located, what is the how much has been extracted, what is the use, what are the benefits of the IP, who is holding, who is the ultimate beneficiary. There is a lot of questions already being asked around IP. And in CT perspective, royalty also is not considered as one of the qualifying activities. So it is taxable here. So IP has been a trigger point in UAE already.
Yeah, and I think in global tax avoidances, there are three transactions that top the list. Yeah, and this is typically the way how tax avoidances happen. First is loans and interest. Second is royalties and IPs. And third is the management fees. Because these are amongst the top fluid transactions that any group or a country or a company could do to shift profits easily from one place to another, right? And I can do that even with having the best transfer pricing model implemented. So these are the three top pain points of any country to stop their tax avoidances overall. So coming out of the substance discussions, what's going to be the best practices across is to stay transparent, record everything, disclose many things in the financials. This will help you in overall commercial substance. Uh, Build in economic value and generate economic value, or the core economic value for every transaction that you undertake, and be compliant. Yeah, these are going to be the three stages of you creating commercial substances in terms of planning. Uh, Quick next steps, because sorry, actually, you have to say something around this.
I would just want to say that, now the points of focus has to be back. What are the action points? And you cannot have certain like a listed action point, but some of the action point which the company has to see is focus on the substance approach now over form. Then hold your board meetings in UAE with physical presence of directors. Ensure that these board meetings are documented. Have your relevant activity within the UAE. To conduct the relevant activity, see that your employees are in UAE. Then what are the regulations around that licensing to hold activity should be considered here, and the ensure control and supervision of these activities, very very important, not just outsourcing it to someone, but the control has to be in UAE. This is what companies should focus on, and then that is where transparency, economic value, and compliance will follow.
So very true, very true. I think a quick next steps. Of course, there is things on the board to really read through. But I would suggest before entering into a transaction, do plan a lot. Build your holding and operational structures with long-term planning and objective setting. Do a lot of documentation. Most of the economies like UAE are not used to documentation for every kind, but keep documenting all the business reasons, decisions, discussions in minutes, one form or the other, or even emails would do. Document it somewhere because that's going to be the ultimate proof. Do not go for structures which will ultimately result into any type of tax avoidances, right? So be clear, be transparent. It's only 9% tax. Other economies have very high taxes overall. So UAE is still blessed with lesser amount of taxes. So soon 15% would come up because of global minimum taxes, but that's okay. That's for certain type of companies or the bigger companies. Try and consult the tax advisors or who have already uh, done certain amount of structuring in and around. If you still have doubts, there is something called as advanced ruling where you can approach the FTA and seek guidance from. Look at tax treaties. Always approach tax treaties in a way where you are fulfilling everything on the MLI and just don't get into tax treaties because it's written there. So go through the objectives, go through the purpose of tax treaty, and then see that whether you are promoting any double non-taxation. The only objective of a tax treaty should be double avoidance of double taxation. It should never be double non-taxation. And I think transfer pricing documentation overall is a great place to build substance. Write your economic story in your transfer pricing document. It can act as a fantastic way to showcase your business to the tax authorities because that's your bridge between you and the tax authorities. So you will have your local files and master files. This can reflect your entire business build-up story. So I think this will take care of overall substance and the way you should be doing business in the UAE going on. Would be happy to have any questions now. We are almost nearing our scheduled time, but would love to have questions, any practical insights for sure. Amira, Ashna, do we have any questions on the board?
I can't
None
see.
at the moment.
If there is no questions, I would like to share a case study at this moment. I think
Okay, we have a
we
question.
have, I think.
Yeah, this is, can you please repeat on royalty taxation point?
Okay, we spoke about multiple IP and royalty-based taxation, but royalty taxation is important when you are paying a royalty on the withholding side. Currently, UAE does not have any withholding taxes, it's set at zero. But UAE is going to follow a resident and a source-based tax, which means in future you can expect withholding taxes to come in. At that point of time, any payment of royalties will become essentially important from a tax analysis point of view, right? And as Ashna said, royalty is one of the high risk transactions from a UAE perspective and will be scrutinized in detail. Are we getting slides of the presentation? You will definitely get the presentation and the link to it for sure. Would foreign entity need to take UAE tax registration? Answer is
Yes.
yes. Uh, yes, it will
If
be available to public.
if UAE company A has a subsidiary B in another country, mm,
Another that.
so tax residence of UAE under poem, what could be the?
What would be the implications for company B if they have not ever filed an ESR in UAE?
Yeah, so there are a lot of non-compliances towards this which are now getting triggered. I would say to to avoid the fear that you are not going to be compliant in the past, don't be be compliant in the future. Start being compliant. Yes, ESR will get triggered because people have declared in notifications that they don't have a poem here, they don't have a PE here, and there is no ESR applicable. But it's just fine. Let's ignore the past and move on. Let's be compliant from now. Past can be tackled with whatever source, but you cannot avoid it from now not to declare.
Yeah. I think the next question is on, can a flexi desk office be considered as a substance in ESR for free zone company? So, okay, the word says adequate substance, okay, and it depends on how you are going to build this flexi desk. So, for your scale of operations, whether a flexi desk is considered as adequate. If the answer is yes, then in that case, are you using that flexi desk on a daily basis, or you just are having a flexi desk and you are working from a mainland or somewhere else? So, just having an office is not enough. That office should be operational, even if it's a flexi office. Somebody should be visiting the office. There should be records of office visits, and that should be used. So, uh,
And besides this, I want to add here, they have already come in ESR. What are the board meetings? What has to be recorded, documented? So that is going to be applicable across even in city. I don't think you can ignore ESR and then say, I have a license and I'm doing business. And that is not, substance is justified. It is already carved out, in the commercial law and the ESR law, what is expected around substance and
yeah. What about the
There's
substance
another.
on direct export? Okay, Amira, you are covering the questions.
Yes, so there's a question, how does a DTA impact the TP?
I think it's a very broad question. The T, I'm assuming it's a deferred tax asset, and we need to understand the reason why the DTA was created. So it's a I would say, vast or vague question. If we can understand the facts around it, I can help it.
Yes, so the next question is, if the company is incorporated post 1st June 2023 in DFZ and in the process of employing staff, will it comply with the substance requirement?
yeah, so there is no hard and fast rule that you have to have substance on day one. Yeah, the government also is understanding that this is a new tax regime. As long as your intent is very clear that you are going to abide by the law, the government is not going to catch your neck and say, now for the 1 month you have not been complied. So the intent is very important. You can always hire and create a substance around the commercial that you needed to be compliant with the law rather than focusing on 1 month of June 23. I think companies now should focus on the longer run. It's not the first, every, this is the first time a country is adopting a tax law. Hiccups will be there. There are many challenges. VAT is still not sorted 5 years and still government is solving VAT issues. So the first month or the first year is always that is right. 3 years are given even as a small business relief to the companies, so that they come out with they learn and they get regularized. So 1 month of not having employees is not that challenging. You have to avoid it in the long run.
Yes, we have another question. Would there be a corporate tax impact in UAE for an Indian entity if that entity is regularly serving its clients in the UAE from India and employees from Indian entity would regularly travel to UAE for providing clients?
So I think in this case, pretty normal, but we need to see the permanent establishment rules from a UAE perspective. And we need to see if the employee is traveling to UAE, what type of economic activity that employee is doing in the UAE, and whether that triggers a permanent establishment exposures in the UAE. So due care and analysis and study is required in this case. Yeah, so you should take care of these things.
Yes, we have another question. If any foreign company is having state-sourced income in the UAE and WHT is 0%, whether it is required to take tax registration in UAE and file tax return.
Sorry, what?
No. So ideally, the answer is no at this point of time. The rules are not that clear that if you are getting income from UAE, which is not taxed in UAE or not taxed at source in UAE, whether you need to take tax registration, the answer is no at this point of time. Yeah, only if you have a permanent establishment or if you are doing business in the UAE, the recent tax circular that came in only cover these two aspects. They don't
If
cover
they earn
non-residents,
UAE
which are
sourced income, then yes. If they earn UAE sourced income and if a PE poem issue triggers, then
then yes. So
yes.
they can earn UAE sourced income with a 0% WHT, which is very normal. Currently, they have not brought in that complexity.
Yes, we have another question. Is royalty paid from DED mainland company to related FZ disallowed in hands of DED company as a dead
No,
company?
it's not disallowed. You will need to undertake transfer pricing for this because this is a domestic transfer pricing issue. So all your royalties paid from mainland to free zone, you because this is going to be a differential tax regime that needs to be at arm's length. So you need to undertake transfer pricing study for this.
Okay, we have one more question. Can a core income generating activity of a designated free zone be outsourced to another free zone?
Now, a very theoretical question's answer is yes, but the theoretical answer is again the supervisory rights and the supervisory activities needs to be undertaken by the free zone, which is outsourcing it, and all the control needs to be generated and exercised by the free zone that has outsourced it.
But it is all there is one condition already in the law that outsource can happen in the free zone. So
And that's why I
provided
said
it
it's
is free
theoretical.
zone,
Yeah,
yes.
yeah.
Okay, I think we'll take two more questions. Can commercial substance be proven for companies engaging only in build to ship transactions?
Commercial
Oh,
substance has nothing to do with build to ship to. It is if you are doing a build to ship to transaction and if you have people on the ground in the UAE, it's fine. But if you are doing a build to ship to transaction with UAE build to and ship to Hong Kong, and you are actually doing it from India and there is nobody in the UAE, then you can't meet commercial substance.
but you have to
Yes,
justify why are you in UAE in the first place when you're not living in UAE, when you don't have
Exactly.
anything to do in UAE. So substance is arising. First of all, you need to justify why are you based in UAE. That is the first question. Okay, just because you are shipping from India to UK, Hong Kong, anywhere you are based in India or Hong Kong, then what is the relevance of UAE in all this? That itself is triggering for substance. The line of business may not need 10 employees or may not need a warehouse, may not need, those are secondary, but the main base of economic reason why you are here itself is the trigger question.
So maybe Asna, I'll quickly give our example, right? I'm sitting right now in India and you sit out of UAE since a very long time, and you are controlling the entire organization there, which is TransPrice DDT. So you and the people there really creates our substance as a firm. While my role is more on the strategy side, where we discuss certain things on the UA, but you are the person on the ground. So that helps. And this is how you create substance. And while we also started doing business in the UAE, we first thing we attack is how we can look at substance. And that's how Asna and the entire on ground colleagues of ours are there, right? Of course, just not for substance, that we do a lot many things, but yeah, this is something that every management needs to think through. Um,
yes. What about the substance on direct export transactions outside UAE to outside UAE, purchase from foreign related party and distribution to third party? the company has a proper setup in UAE?
So the question has the answer. It says the company has a proper setup in UAE. So if you have a proper setup in UAE, that means all the guidelines have been followed. So which means the substance is created in UAE and you don't need to take delivery in the UAE. It is fully taxable entity.
Okay, and the last question for today, how benchmarking we can do without UAE data? Can we take other Gulf countries' data from the same?
So whether it is a transfer pricing discussion or no, whenever we are talking of UAE, I always get this question. So which is great. So benchmarking can be done. Of course, there is UAE data available, but UAE follows OECD methodology. So we follow something called as regional benchmarks. So wherever there is a possibility, we look at a Middle Eastern type of a benchmark overall and try to do adjustments at a country level wherever we could. Now, these adjustments could be for country risk, it could be for foreign exchanges, it could also be for other aspects. So all these adjustments is what we do to come to a conclusion of what is expected in UAE from a benchmarking point of view.
Okay, we've got a last question. Can a core income generating activity of a designated free zone be outsourced to another free zone specifically about distribution activity, which is qualified for designated free zone but not for simple free zone?
It is Betty bought some butter, the butter was bitter. It looks like that. Free zone to free zone. Sorry, I am confused with this question. Asna, if you could.
What is the question? Sorry. Please.
So it,
I also did not get the question. If we registered in free zone and only have investment in UAE company, this one, Amira?
No,
no,
the one
the
above.
earlier one.
One above.
Okay, can a core income generating activity of a designated free zone be outsourced to another free zone, specifically about distribution activity, which is qualified activity? Yeah, so this is already given in the list of activity in the conditions for qualifying free zone. The outsourcing is allowed, but within in the free zone. So from one free zone to another free zone, it is perfectly fine, provided that other free zone also has a proper substance. So it should not be like, you're outsourcing to someone which doesn't have a substance, and that type of activity needs substance. So outsourcing from a designated zone to another free zone is carved out specifically in the law. So there is no doubt there.
If we register free zone company and only have investment in UAE company holding shares, how we will justify the adequate substance?
So this is the more holding company structure in the UAE. Again, you have to see the nature of investments which are there, whether the investments are in UAE or the investments are across the globe, and what will be the dividends, or what are the royalties that this holding company will be earning, what is the nature of revenue, because holding company per se is an activity carved out in ESR also. So you have to study what is the ultimate income that a holding company is going to earn from this substance. Again, this holding company will have UBOs. Who are the ultimate beneficiary owners? What are the kind of investment activities this holding company is doing in UAE? If you can add something, Akshay, here as a substance to holding company, which is only for investment purposes.
No, I think we have covered it. Overall, I think substance for holding company is going to be the people around, and especially the qualification of people and the experience that they have in holding companies. So it has to be more qualitative in nature. I think we take the last question now, Amira. How to determine adequate substance requirements for shipping companies doing international transport? As I said, adequate is a very dicey word. So best is to look at other shipping companies in and around in terms of what type of expenditures do they have, what type of employee strength do they have, what type of functions do they do. Document all of those, and that is how you can drive the substance requirement for a shipping company. Yeah. In short, a study is required. Great. I think any closing remarks from your side, Ashna?
Closing remarks is don't get scared of the hiccups and the challenges that the UAE market is throwing on all of us, whether you are an industry or a consultant side. There are challenges, there are cabinet decisions every day which are coming and getting released. The focus and the intent, I always say the intent is doing business in the UAE, then all the other challenges can be met without any fear or without substance is a concept which is which everybody knows actually how to do. It's not that it is not it is just that the people have to start believing now and build the right substance around the activity and the company. uh, Tax has to be paid. More we start accepting that we have to pay the tax, and anyways it's only 9% here in the UAE. The sooner the companies will be compliant.
Great. So, okay, so thank you, everybody. I think if you have any questions more on substance, always feel free to write. Uh, yeah, it's a very vast topic, something that will not come into books because the experiences and the business dynamics are all going to be different. So always happy to talk. And till then, next time, thank you all for a patient listening. I hope this was a value addition to you. And yeah, have a great evening, everybody, and a great week ahead. Yeah, bye.
Okay.